You ever see the term value fund and just wonder, what does that actually mean? How do they find these so-called value stocks? Well, today, we're going to pull back the curtain. We're diving straight into the official document for the Kotak Nifty200 Value 30 Index Fund to see exactly how it ticks. Let's get right into it. I mean, this is the million-dollar question for any investor, right? How do you spot those hidden gems, the really solid companies that, for whatever reason, the market just isn't giving enough credit to? That whole idea, that's the very heart of what's called value investing. And it is literally the entire game plan for the fund we're looking at today. So here's how we're going to break it all down. First up, what even is this thing? Then the fun part. How does it actually find value? After that, we'll weigh the risks and the rewards, figure out who this is really built for, and finally, we'll get into the important numbers you absolutely need to know. Okay, let's start at the very beginning. Before we get into all the complex mechanics, what exactly are we dealing with here? Let's just nail down the basics, based on what the official document tells us. Okay, so at its core, it's an index fund. The easiest way to think about it is, it's like buying a pre-made grocery basket. Instead of you running around the store picking every single stock yourself, you're just buying a bundle that's designed to automatically copy a specific market index. It's a hands-off, passive way to invest. Now, this slide is basically the fund's ID card. These 4 points, taken straight from the official paperwork, tell you almost everything you need to know at a glance. It's open-ended, which means you can get in or out whenever you want. It tracks a very specific index, the Nifty200 Value 30. Its whole purpose? Long-term growth. And its method? It's a completely passive, rules-based strategy. No active manager making gut calls here. So this is the really cool part. How does a formula actually find value? It's not some kind of magic black box, you know? It's a very clear step-by-step mechanical process. Let's dig into how it actually builds its portfolio. You can see the whole process here, and it really is like a funnel. It starts big with a huge pool of 200 large and mid-sized companies. Then it runs every single one of those companies through a scoring system based on those key value metrics. And out from the narrow bottom of the funnel comes the final portfolio, just the top 30 highest scoring companies. That's it. So what's in that secret sauce? What are these value metrics anyway? Well, there are these 4 things right here. The formula is basically asking 4 simple questions about every company. How much is it earning? What's its net worth? How much is it selling? And what dividends is it paying? All compared to its current stock price. See, the whole philosophy here is that sometimes a company's stock price gets disconnected from its actual business health. This strategy is all about finding those strong, solid companies that the market might be ignoring or unfairly punishing at the moment. Okay, now let's talk about the other side of the coin, because let's be real, there's no such thing as a risk-free investment. It is absolutely crucial to have a clear-eyed view of both the potential upsides and the potential downsides, and the official documents are very clear about this. And here it is, straight from the horse's mouth. This is the official riskometer from the fund's own document. And, well, it doesn't pull any punches. That needle is firmly in the very high risk category. And why is that? It's pretty simple. This fund is almost entirely invested in the stock market. And the stock market, as we all know, can be a wild ride. So let's really weigh this out. On the one hand, the potential upside is that you're investing in a curated list of companies that the formula thinks are on sale, all with the goal of long-term growth. Sounds pretty good. But on the flip side, you've got that very high market risk we just saw. There's also something called tracking error, which just means the fund might not perfectly mirror its index because of small things like fees. And finally, since it only holds 30 stocks, there's concentration risk. Your performance is really, really tied to how that specific group of 30 companies does. So now that we've seen how it works and what the risks are, the big question is, who is this actually for? Does this kind of product fit your profile as an investor? Well, the document itself gives a pretty straightforward answer. It says, and I'm quoting here, it's for investors who are seeking long-term capital growth. Let me translate that. This is not for someone trying to make a quick buck. This is designed for people who are in it for the long haul, who can stomach the ups and downs of the market, and who fundamentally believe in this philosophy of value investing. All right, last section. Let's get down to brass tacks and look at the fine print. These are the hard numbers from the document that you've just got to know. First up, how much do you need to get in the door? Just 100 rupees. That's it. This makes it incredibly accessible, which is great whether you're a total beginner or you just want to add a little bit at a time. And what if you want to take your money out? Well, this is a big one. The official document says there is a 0% exit load. That means no fee, no penalty if you decide to sell your units. That gives you a ton of flexibility. Of course, running a fund isn't free. That's where the total expense ratio, or TER, comes in. Think of it as the annual fee for the fund's operations. For this fund, the absolute maximum they can charge is capped at 1% per year, covering all the behind-the-scenes costs. So when you put your money in, where does it go? As you can see, it's super simple. The vast majority of it, at least 95%, goes straight into buying the stocks from the index. That tiny little 5% sliver, that's just a bit of cash or other safe stuff they keep on hand to manage daily operations, like when people want to cash out. So here we are at the end. We've gone through the whole thing. We've seen exactly how this fund uses a rules-based system to find what it considers undervalued companies. We've looked at the risks, we've looked at the costs. And that brings us to the final and most important question. And this one isn't for me to answer, it's for you to consider. Does this specific approach of seeking value align with your own long-term financial goals and your own comfort with risk?